And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? Today's going to be a little bit different of a video, one that is kind of somewhat bittersweet. I have been faithful, and over the course of the last 10 years, I've certainly enjoyed doing radio shows in southern Minnesota, northern Iowa, and that day has now come to a close. As of today, this will be the very last radio show that I do that is broadcast. However, do not be alarmed. You have made yourself very clear that you love the on-demand visual video podcasts. And so I'm not going anywhere. I'm not doing anything really differently. I'm just changing the format and putting more of an emphasis on the podcasts, making them maybe shorter, more concise, maybe a little bit more fun. Who knows? It's yet to be seen. But the reality is that I just want to say in the beginning of this little short podcast, I want to say thank you for your loyalty. Thank you for listening. Thank you for watching. Thank you for supporting me, sending me questions and topics that you want to have me discuss and review. It's been absolutely edifying. It's been gratifying. It's been a joy and a real labor of love to be able to sit down in front of the microphone and to sometimes share my heart, other times share things that are more lighthearted and fun. Today may be one of those areas that is a little on the heavier side. And not so much because I want to be a Debbie Downer and I want to be, killing your dreams, or as they would say, peeing in your pom-poms. That's not it at all. But I do want to have a conversation with some of you that are, you've taken the approach of risk on with investing in particular stocks. Now, for some of you, this is by default. When you think about the corporation that you work for, you may have an employee stock option program, and that employee stock option program is obviously investing in the corporation's stock that you work for. And your stock, you're handcuffed. You can't go anywhere while you're still working. For some of you, it is a voluntary thing. Maybe you work for a corporation where you have a 401k, and that 401k allows you not only a profit sharing program, but it allows you the opportunity of being able to buy more stock. And so paycheck to paycheck, you're pumping money in, you're buying shares of your company stock. And then there's some of you that have willingly just gone out and you've taken the initiative to find stocks that maybe you really liked, maybe through research, maybe through the tip of a friend or the tip of a family member, and you've gone after it and you've just plowed a ton of money into the particular stock that you like. Now, is any of this wrong? And the answer is absolutely not. If you feel comfortable putting a lot of money into one particular corporation and one stock, and you're willing to trust that amount of money to that corporate CEO, then, all the power to you. But in many respects, these things tend to get out of control. In many respects, these things tend to grow large over the course of time, and before you know it, it can represent a very sizable percentage of our overall net worth. For instance, individuals that might work for, Hormel, or they might work for Heinz, or they might work for some engineering company. These are things that over the course of time, when you first started, they didn't mean much. You invested and the stock price was low and you kept buying and buying and buying. But now over the course of time, you look at the stock option account and it's well in excess of $500,000, or even for some of you, $1 million. And I want you to just think about this for just a moment. This is just a very simple analogy, okay? I want you to imagine that you go into a casino and you walk up to a gaming table, and that gaming table has a little placard, a little sign on the side of the table. And it says, if you win $5, and if you lose 50. Now, I want to ask you this question. I think you know where I'm already going with this. Are you going to play that game? Are you going to play that game? And for most, shall we say, logical, sane individuals, the answer is absolutely not. And when I ask you, well, why wouldn't you play the game? You say, well, there's just too much downside. You see, this is where we have to become more of a student. When we're investing in certain corporations, we want to be very careful to think about and to understand and to know in advance and to track something called the price to earnings ratio. Price to earnings ratios they're not the end all of information, but they are a very good indicator of whether or not a stock is overinflated. Now, even if it has a good price to earnings ratio and it would appear to be a good bargain, doesn't necessarily make it so. You could end up buying into what's called a value trap, where the stock just does nothing. It just stays the same. It tracks sideways forever. And obviously, that is not in your best interest. But I want to share this with you, and I really want you to pay attention now. You see, if you would think it would be, well, it would be negligent of me to take, say, $3 million of your dollars and to go out and to buy a business, an ice cream parlor, for instance, that makes $100,000. If you would look at that math and go, well, that's ridiculous, Matthew. Why would you ever do that with my money? I'm going to have to scoop ice cream for 30 years before I make my money back. Well, that's the point I want to try to get across to you. When you look at these AI companies, when you look at the technology companies, realize that they could continue to go up. They could continue to go on, reaching new highs. But the higher they go, the more difficult it becomes for them to go higher. It's one of those diminishing returns. In the same way that gaming table said, if you win $5, but if you lose 50, you begin to realize that as these corporate stock prices get higher and higher and higher, well, it's harder and harder for the company to justify a higher stock price. And eventually things start to wane, they start to peter out, they start to fizzle, and then all of a sudden the market or that particular stock begins to backtrack. It begins to pull back, retrace, come down, starts to lose. And here's the real injustice, okay? Pay careful attention. The real injustice is that your brain, you have this thing called a normalcy bias, and your brain is saying to you, that's okay, this time it's going to be different. It's okay, we've been here before. It's going to keep going higher. And you know what? Maybe you're right. Maybe you're right. Maybe it will retrace, and then all of a sudden it'll take off and it'll go higher. It'll do more. And you'll go, see. But you see, every time that takes place, my friend, that's training your brain to become more desensitized to the risk. So again, is it wrong for you to have a particular darling within your portfolio? Some stock that you just love, some stock that you've really focused on investing in? Have you really bought into the whole business model, I guess, or the company creed where, if you're going to work for us, you're going to own our stock, and to do anything else would be, that'd be unpatriotic. Have you fallen victim to that? Because, my friends, this is a very elevated market. This is a market that has all the hallmarks of emotion, not logic. And if you have more than, say, 5 to 10% of your money sitting in any one particular name, that could be an area that would cause you trouble, an area that could cause you some pain, some heartache. And so I encourage you, if you've been doting over a particular company, a particular stock, have it analyzed. Have a second opinion. Make certain that it's still good to hold. And see, here's the thing. Some people will even go as far as excusing and saying, listen, I can't sell because if I do sell the stock, Matthew, I'm going to end up just getting clobbered with taxes. And it could be true that you're going to pay some capital gains tax on it, but realize that we're in the lowest capital gains tax rate that we've been in 35 years. If you're in the 12% tax bracket, you've got 0% federal capital gains tax. If you're in the 22% tax bracket, you still get a discount at 15%. Now, based upon your state, your mileage may vary. But the reality is that we want to be careful of having too much of our money in any one particular name, any one particular sector. For those of you that are saying, well, I don't have that problem. I've got all my money in precious metals. Well, I hate to break it to you, but whether you're investing in a commodity like gold or you're investing in a stock like Hormel, it doesn't really matter. It's still the same kind of thing. It could be real estate. We all see bubbles, and we all know what happens to bubbles. So from me to you, this is not to say don't keep doing what you're doing. If you feel comfortable and you know that you've got a good set of analysis to justify holding on to your stocks. Maybe you're stuck in the ESOP and you can't go anywhere. I appreciate that. But if you have seen growth, if you have seen gains, I encourage you, don't get greedy. Take some of those winnings off the table. Diversify and help yourself be more protected from the uncertainties of tomorrow. I'm Matthew Johnson. Thank you so much for watching and listening. And remember, it's up to you to make today a great day.